Over the last 10 trading days or so, South Korea's stock market has gone through one of the sharpest reversals in the world. What had looked like a powerful AI and semiconductor-driven boom suddenly turned into a leveraged unwind, and for many investors the damage is already permanent. That is why it is reasonable to say the bubble may have already popped, especially for investors whose accounts were liquidated by margin calls. To understand what happened, start with the run-up. Korea's KOSPI had been one of the strongest equity markets in the world, driven heavily by enthusiasm around AI, semiconductors, and leveraged retail speculation. The index pushed above 7,000 in May and eventually reached a record-closing high near 9,114 in late June. In one especially dramatic stretch, the market ran from about 6,000 to above 8,000 in just 9 trading days before abruptly cracking. That kind of move is usually a warning sign by itself. It suggests the market is no longer moving mainly on fundamentals, but increasingly on momentum, leverage, and fear of missing out. In Korea's case, much of the bullish positioning was concentrated in a narrow AI and semiconductor trade, which made the whole market more fragile than it looked on the surface. Then came the reversal. According to reporting, the KOSPI plunged by about 20% in just 2 weeks, from June 22nd to July 9th. On July 13th alone, the index dropped 8.95%, severe enough to trigger the sell-side sidecar and a level 1 circuit breaker. By July 16th, the KOSPI fell another 6.37%, and by then, the market had lost roughly 25% to 27% from its peak. What turned this from a correction into a crisis for many retail investors was the enormous amount of margin debt built into the rally. Korean retail investors' margin balances reportedly hit a record around 38 trillion won, which was more than 70% above the level at the end of the prior year. That means a huge amount of buying power in the market was borrowed, not paid in cash. Borrowed money makes gains feel bigger on the way up, but it also makes losses far more dangerous on the way down. Once prices start falling, brokers demand more collateral. If investors cannot meet those calls, positions are forcibly sold. That forced selling drives prices even lower, which triggers more margin calls, and that creates a vicious cycle. That is exactly what appears to have happened in Korea. Reports say roughly 1.2 million leveraged retail accounts were hit with margin calls, and an estimated 320,000 or more accounts were forced into liquidation. July forced liquidations alone reportedly totaled around 344.2 billion won, with some single days above 100 billion won. This is why the phrase, "the bubble has popped," is not just media drama. A bubble does not need the entire market to go to zero. It only needs a speculative structure where prices become detached from sustainable funding and where the unwind destroys participant capital. When a large number of investors lose their equity through forced liquidations, the bubble has effectively popped for them, even if prices later rebound. In fact, some analysts argue that the underlying AI and memory cycle story did not suddenly disappear. What broke was the structure of the trade. Too much leverage, too much crowding, too much narrow leadership, and too little room for disappointment. That distinction is important because it means the long-term industry story and the short-term market bubble are not the same thing. So the lesson from Korea is clear. A market can have a real long-term theme, like AI, and still become a dangerous bubble if too many investors chase it with borrowed money. Once margin calls start to dominate price action, the market stops trading on narrative and starts trading on forced deleveraging. And for the investors who were wiped out in that process, the bubble has already popped, whether or not the index eventually finds a bottom. If you enjoyed this video, remember to like, comment, subscribe, and turn on notifications to not miss out on the next videos.